Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 1st of April. I'm Daniel Lam, your host for the podcast. Over the last 6 weeks, we've all been in varying degrees of gloomy mood because of the conflict in the Middle East, regardless of whether you're an investor or not. And today is April Fool's Day. It's supposed to be a more light-hearted occasion. So I'd like to minimize my discussion about the conflict and look at some longer-term observations in the tech space. In the latest earnings season, it is apparent that the key US technology companies had, in general, outperformed their Chinese counterparts. The conflict in the Middle East compounded this outperformance because China is a net oil importer and investors have been seeking relative haven in the net oil exporters, such as in US equities. The US tech companies show that they have stronger pricing power, scale, and better efficiencies. It is interesting to note that major US tech companies spent 6 to 8 times more in absolute US dollar terms in terms of capex versus their Chinese counterparts. Now, if you adjust the capex size through dividing by the respective revenues, then the US tech companies still doubles the capex intensity versus Chinese ones. And to counter those who are concerned about the massive spending by US tech companies, their capex is 6 to 8 times higher than Chinese companies, and their revenue is also 6 to 8 times higher. Moreover, their operating profit is over 20 times more than their Chinese counterparts. So one can say that US tech company platforms are investing much more aggressively into AI, going for developing artificial general intelligence, while Chinese companies are going for the incremental gains in AI rather than transformational breaks. So how much of all these is in the price? Well, Chinese equities are trading at a sizable discount versus US equities. But we need catalysts in order to close this discount in a meaningful manner. So there are factors, such as another DeepSeek moment, that can certainly help. But as we said, Chinese companies are more about incremental gains rather than transformational breaks. The other catalyst is a weakening US dollar. Now that is possible if there were to be de-escalation in the Middle East conflict, leading to less fears of inflation, slowly resulting in the return of Fed rate cut expectations, and thus a weakening US dollar. Now, a weak US dollar means cheaper import costs for Asia, as well as likely rotational fund inflow. For now, we see that investors who are seeking growth in the tech space will be looking at the US stocks, while those that are more value-oriented will be looking at Chinese ones. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.